Hello, and welcome to our Real Estate Investor Workshop. Today, we'll be answering all your real estate questions. My name is Michael Matthew. I've been a chartered accountant for more than 30 years. My international practice is focused on real estate and real estate investors. I'm also the CFO for a local home builder. I own a condo in the Toronto area. I'm currently looking for small apartments in the US, specifically in Texas. I offer entity structuring or setting up of corporations both in Canada and the US, operational and tax consulting and planning, and tax return preparation for both Canada and the US returns. In terms of plans for the group, the plan is to meet once a month at 7 p.m. on the last Thursday of the month, subject to change around holidays, etc. I will be delivering most of the content with occasional guest speakers. We will address various issues related to real estate investing and related topics such as financing. Happy to take suggestions for future sessions from the group. So today, what we'll be covering is answering your questions based on our previous webinars. Before we do that, just a brief disclaimer to keep my lawyer happy. None of the information provided in this presentation or provided through this presentation is given as tax, accounting, or legal advice, and it shall not be relied upon as such. None of the materials are to be construed as a solicitation, recommendation, or offer to buy or sell any security, product, property, or instrument. And while I do my best to keep the information presented here as current as possible, please be aware that a court case could come out tomorrow. The government could pass new legislation tomorrow, which would change part of the presentation. So do consult with your tax advisor before making any real estate moves. If you have more detailed questions you'd like to answer on a one-on-one session or something you'd like to discuss, please email me at michael@mmcpaca.com to arrange a mutually convenient time to meet. Our next event will take place on November 24th at 7 p.m. and it will involve Scott Cordier presenting on the topic of infinite banking. So please grab a pen and paper or open up a document on your computer and get ready for making some notes. I'm just going to turn off my camera for the presentation, come back on a little bit later. So question number one, what are the most common deductions for real estate investors? This is a very common question, and obviously you need to know what you're going to be able to deduct to minimize the taxes. So you have things like advertising, auto expenses. Now with auto expenses, things vary based on how many properties you own. Specifically, if you only own one property, you can only deduct motor vehicle expenses if the rental property is in the same general area that you live in. You do the repairs and maintenance for the property, and you incur these expenses to transfer tools and materials to the property. You cannot deduct these expenses that are incurred for the purpose of collecting rent if you only have one property. If you have two or more properties, then in addition to being able to claim auto expenses for what we just spoke about, you can also deduct for the following reasons: to collect rent, to supervise repairs, or to generally manage the property. Capital cost allowance is the tax term that Canada Revenue Agency, CRA, uses to represent the depreciation or wear and tear on enduring assets such as a building. It allows you to defer a portion of the income on the property until the year you sell it. When you do sell it, all the CCA deductions that you've taken throughout the years have to be reported as regular income, assuming that you have a gain on the sale of the property. Generally, if the rental property was or is your principal residence, it's advisable not to claim the CCA. So you preserve 100% of your principal residence exemption for the maximum period allowed. And the principal residence exemption, or PRE, is what allows you to sell your home for a substantial gain and not pay any capital gains tax. On the other hand, if you expect to sell at a significant gain that will put you in the top tax bracket, you may not want to claim CCA, as you'll be deducting CCA at the lower typical rate for you and paying tax at the highest possible rate, which in Ontario right now, for income north of 220,000, approximately, you're looking at over 53% tax. Commissions paid if you use a realtor to find a tenant for you, as an example. Financing charges are typically deductible over the term of the mortgage, i.e. 5 years in most cases. Home office expenses. You can deduct home office expenses for your rental business, things like cell phone and internet, which are not prorated, and also things like rent or mortgage interest, insurance, property taxes, repairs, and utilities, which are prorated typically as a ratio of the square footage of your office as a fraction of the total square footage of your home. So for instance, if you have a home office that is 200 square feet and the square footage of your home is a total of 2,000 square feet, you'd be able to deduct 10% of those latter group of expenses, the rent or mortgage interest, insurance, property taxes, repairs, utilities, and so on. Insurance. Obviously, if you have rental property, you're going to want to deduct the insurance, and you're going to want to have insurance to protect your interests. Some people overlook the line of credit interest. Sometimes a line of credit is used for a down payment, that sort of thing. Whatever it's used for, provided it's used in your rental business, your real estate business, you can deduct those interest charges as well. Professional fees paid to an accountant such as myself to help you prepare your rental schedules and your tax return. Interesting enough, legal fees are not deductible immediately. The legal fees you pay regarding the purchase of your property are added to the adjusted cost base, ACB, or the carrying value. So let's say you bought a house for $1 million and you paid $2,000 of legal fees. Your base cost for that house in terms of tax purposes is not $1 million, it's $1 million plus the 2,000 to equal 1,002,000. Mortgage interest, I think people understand that's deductible. Just make sure you're deducting just the interest, but not the principal payments, because they are not deductible. Property management. So if you pay someone to professionally manage your property, those fees would be deductible. Property taxes, and this is one of the most commonly missed expenses, is the property taxes and utility deductions in the year of purchase or the year of sale. These adjustments are listed by the lawyers in a document called Statement of Adjustments. Repairs and maintenance. The tricky part is determine whether an expense incurred should be capitalized and written off over time or should be expensed immediately. And you're going to want to talk to your advisor to help you on the close calls, because there are some expenses like utilities that are typically deductible immediately, and others like legal fees on the purchase, as mentioned earlier, that is added to the cost base. And utilities, of course, would be deductible. Next question is, how long do I have to keep my cost records? Sorry about that. You have to keep your records for 6 years after the year they applied to, or the year the return was filed, whichever is later. So you can't cut that 6 years in half by not filing your return for 3 years. It's the later date of the two. Another common question is, should I incorporate? It's going to depend on your situation. The starting point to look at is what are the tax rates. As an individual in Ontario, you're taxed at 20% to 53% plus, regardless of the nature of the income. A corporation passive income is taxed at one flat rate of 50% plus, regardless of the income amount. And passive income includes things like capital gains on rental property and the rental income itself on a year-by-year basis. If you have active income in your corporation, it's taxed at 12.2% in Ontario, up to $500,000 in net income, or income minus all your expenses. And after that, any amount is taxed at 26.5%. So there are a number of factors to consider when you're trying to make the decision. Some of the advantages of having corporate ownership is it makes dealing with many owners of a property much easier. You provides a preferable investment structure if you're trying to target more expensive properties. It makes estate planning much easier, as distribution of shares is far simpler than trying to distribute real estate, and it provides legal liability and creditor protection, as only the assets in the corporation, which is usually just the property or properties, are at risk. Typical exception being a traditional lender almost always requires personal guarantees on their loans. So you're not going to get typically creditor protection from the bank, but it will apply to other types of creditors. It also gives you flexibility when it comes to the timing and nature of payments, such as bonuses, dividends, management fees, and wages. It allows payment of reasonable salaries to split income according to who's doing the work. Now, of course, there's some disadvantages as well. It may be harder to qualify for a mortgage. Mortgage interest costs will be higher. It's simply a supply and demand situation. There are fewer lenders willing to lend to the corporations, so the demand being constant, in that case, it will push the rates higher. So as a rule of thumb, you can expect to pay roughly 1% more in terms of your annual interest rate than you would pay if the mortgage was obtained in your personal name. And in addition, there's typically a 1% lender fee spread over the term of the mortgage. Corporate ownership is more complex and costly. You need other structures set up, and of course, you have additional tax returns to file, i.e. your corporate tax return. Income taxes are at a fixed high rate, 50% plus, when a corporation earns rental income, which may be higher than your personal income tax rate. Incorporation is recommended if you'll be fixing and flipping, properties, especially if the profit will remain the corporation for a year or two or more. Also, it's recommended if you're buying into a bigger project, such as a 50 or 100 unit apartment building, or if asset protection or estate planning is a primary concern. There are advantages to buying personally. It may be easier to qualify for a mortgage. It's simpler and cheaper. There's no other structures or returns required. You can also have to take into account the disadvantages. At a certain point, which could be 4, 5, 6 properties, lenders will not allow you to borrow additional funds, regardless of your credit rating or the cash flow from the property. And typically, they're not going to tell you until it's time to refuse to do business with you that this is the case. All your personal assets are at risk should there be a legal dispute involving one of your properties. So, next question, what are the factors to consider when a Canadian invests in the US? There's additional tax forms or returns to be filled in. It's a T1134 if it's held through a foreign corporation, assuming the cost of the property is more than $100,000. And that's due within 10 months of the corporate year end. We've talked about asset protection and estate planning. They become more complicated when you're factoring in cross-border investments. Also, how much income you plan to repatriate or bring back each year. Some people decide that their plan is to build up some cash in the US, leave it there to buy a second property and act as a down payment on said property. Or conversely, others decide that they want to bring back the money as quickly as possible. And then you get into things like withholding taxes because you're paying money to a foreign resident. And you have to obviously factor in foreign exchange. You may have to file foreign tax and information returns, whether you're incorporated or not. Business entities may have to file and pay additional fees to qualify to do business in states where the property is located. And many states are now more aggressive at enforcing and collecting income sourced from property located in their state. I want to just mention about LLCs before we get to the foreign exchange topic. They're typically not a good idea for Canadians because it's treated as a corporation or Canadian tax law, and not as a pass-through non-taxable entity as Americans treat them. So you end up getting taxed on whatever distribution from the LLC as a foreign dividend, and you have no tax credit available to claim against that, which means you're going to end up paying taxes in the States and in Canada without any tax relief. Foreign exchange. The timing of your transfer can increase or wipe out your profit depending on swings in the relative value of the Canadian and US dollars. So having the ability to change the timing of moving funds can be very beneficial. And when you're transferring significant funds, so I'm not talking just a small down payment, but actually purchasing some real estate, you should always consult with a foreign exchange trader, because most of the time they have to have a better exchange rate than the large banks. And that's simply because if their rates were not better most of the time, they wouldn't have any business. All right, the next question, we're going to touch on a couple ways that HST applies to real estate. First of all, if the only source of income for your company is residential real estate, long-term leases, so we're talking 30 days plus, so typically it's going to be for a year at that point, you cannot legitimately register for HST and you cannot legitimately claim input tax credits for the HST that was paid out by your business. So don't do it, because if you do manage to get registered, you'll end up having to pay back all the deductions that you took off the HST and end up paying interest on that. So only if you qualify to register under other types of situations, such as you have a commercial tenant. So if you're renting out commercial real estate, then yes, you do charge HST on that, which means you do get to claim the HST that you've paid towards the expenses to maintain that property. CRA's position is you're going to pay it on the flips of pre-construction condos. So you put a deposit on a condo, but don't actually take possession of it and sell it instead before that time. You're going to pay HST on that unless you have a reasonable justification for your change in plans to reside there. As an example, perhaps you get transferred to the other side of the country and therefore you weren't going to be living in that house, then CRA would not insist on you being hit with an HST charge on that, or being treated as business income. Also, short-term rentals like Airbnb or VRBO, if it's for less than 30 days in a row, you're going to have to charge HST on that. So as a starting point, HST applies to all sales of real estate with several exceptions. Number one is resale of a residential property is going to be exempted from HST unless at least 90% of the interior of the building, excluding the foundation, external walls, roof, floor, staircases, have been removed or replaced. So unless you're doing a total gut job where you rip everything out down to the studs and remodel and renovate from there, you're not going to likely be getting anywhere near this 90%. No HST is payable if the individual sells personal use vacant land. So no structure on it and it was personal use, then you're okay. CRA's position that when you're flipping, the HST will be payable by the initial buyer on the entire sales price, whether it represents deposits paid by the initial buyer, assigner, or profit on the sale. A lot of people think that if they put down, 50, 100,000 in deposits, well, that much, there's no HST on. No, CRA's position is there is HST on everything. And there is case law to the contrary. So it's a rather tricky area. Be sure to consult with your tax advisor if you're selling a pre-construction condo or assigning it, as the language is typically used. You have to report any profit realized from an assignment sale in the tax year in which the right is assigned. And it'll be either treated as fully taxable business income or income from a capital gain, only 50% of which is taxable. And this area can get quite complicated. For instance, they use the term builder being subject to HST, and builder is not the person that actually constructs it. For HST purposes, I mean. So CRA also looks at the primary and secondary intent, and they want to determine what your primary purpose was. And then they'll also look at your secondary purpose. So some of the factors they look at when evaluating the primary purpose is you offer to sell your interest in the house or take other actions to attract buyers before or while the house is under construction. The purchase is financed by short-term penalty or open mortgage that can be paid without penalty, rather than a long-term or closed mortgage. Financing of the house. So this means when you actually would have to close, is beyond the person's means. And that person is relying on the increased value and sellability of the house or an interest in the house. The person's pattern of activity is such that their occupancy of the house does not have the qualities or characteristics of being permanent. For example, the same person purchases multiple houses at the same time. Well, obviously the intent can't be to live in each one. And they also look at, have you done this before or not? So there's quite a few factors. Unfortunately, CRA's position tends to be that if most of the factors are in your favor, then the few that are in CRA's favor are by far the most important, therefore outweigh your points. And if it's a reverse situation where you have just a few points, but they're pretty solid, and CRA has many points in their favor, their position, they said, well, you have to look at all the points added together. So they're definitely not consistent. Next question is, will the sale be considered on account of income or capital? And why this matters to you is if it's on account of income, it will be 100% taxable at your marginal tax rate. And if it's on account of capital, then it'll, in other words, it'll be a capital gain situation. Only 50% of the gain will be taxable. And they look at primary and secondary intent, and that includes the location and the zoned use of the real estate, the nature of the taxpayer's business, length of time the real estate was held, any other persons involved in real estate, their occupations, factors that motivate the sale. So again, it is a fairly comprehensive list of factors which is examined on a case-by-case basis. There's also the doctrine of secondary intent, where the taxpayer has an alternate intention at the time of acquiring real estate of reselling it at a profit if the main or primary intention is thwarted. So basically they're saying at that point that you had a secondary intention from the start to sell this at a gain, and therefore it should be 100% taxable. Next question is, who are typical power team members? A coach or mentor, a real estate broker, property inspector. They can save you a lot of money because you pay a little bit of money to them to find out that you shouldn't buy a property, as happened in my case when I put an offer on 5 properties in Ohio. The inspection came back with some pretty significant faults, including the landscaping was done such that all the water would run into the house, not run away from the house. Also, it was a bad property manager situation. You're going to need a lender, an accountant, a lawyer, a mortgage agent, an appraiser, an insurance agent, a designer or architect if you're doing renovations, a contractor if there are significant repairs, a property manager, and potentially a paralegal to deal with tenant issues. So those are the questions that come in. I'm just checking the chat to see if there are any more to add. In other words, things that we haven't covered. And I'm not seeing anything. So again, there's my contact information if you would like to reach out to me and book a complimentary consultation for 30 minutes, either at the email you see or my phone number, 416-722-3918. And I'm just going to stop that share. Okay, and I'm just, as I said, double checking In the chat, I don't see anything else, so I guess that's it for now, and I hope to see you at our next presentation. Bye now.